Hello everyone, a very good morning. Welcome to Oliveboard. So today this session we are going to discuss about the previous year paper, May 2025. These questions that we are going to discuss today, these are the must attempt questions for your RBWM exam, right? So before exam, because these questions are based on those topics that were asked in your previous exam cycle. We'll be having many sessions like this on our weekend so that you can attend all of these sessions. What we are going to do, we'll be I'll be showing you some questions on the screen. We'll be discussing the answers and also the related topic alongside. So along with the questions, you're also going to get the explanation of each and every topic. So make sure that you attend the complete session, you answer all of these questions. All of these questions are very important. What is going to be the agenda of this session? To practice the most important MCQs for the JIB RBWM November 2025 exam. All right. So once you're here, please mark your presence and be active in the session. All of these questions are based on the topics that have been asked in your May exam of 2025. All right, so let us start. First question. A sum of rupees 2000 is invested at an interest rate of 8% per annum. Approximately how many years will it take for the money to double? The options are 9 years, 12 years, 18 years, or 24 years. So, in this exam cycle, we saw many questions from our Module E. That is the additional reading material on home loans. From there, one question was asked from the rule. There are three rules in which we discuss about the time value of money, right? There are three rules. The rule of 72, which tells us that our money is going to double, it will become double in these many years. Then we also have the rule that is going to tell us in how many years it will become three times, in how many years it will become four times. All right, so this is the concept of time value of money. All right, the rule of 72, 115 and 144. Here you need to tell me in how many years this rupees 2000 which is invested today at an interest rate of 8% per annum will become double. To see in how many years it will become double, simply we do what? We divide the rate of interest, right? So 72 is the rule that is followed. 72 divided by what is our rate of interest? It is 8%, right? So the correct answer will become A, 9 years. The correct answer is A, 9 years. 72 divided by 8. Similarly, if I want to see in how many years it will become 3 times, so I will divide 144 by 8. 144 by 8. If I want to see in how many years, no, it 115 by 8. And in how many years it will become 3 times, so 144 divided by 8, right? So these are the rules of 72, 115 and 144. These rules allow you to determine the number of years before your money becomes almost double, triple and four times. Simply divide the number by the percentage rate that you are paying on your debt or you are earning on your investment. It will give the years during which the money will double, triple, or four times, respectively. All right, so here the correct answer is A, 9 years. All right, so I hope this concept is clear. And this question was asked in your exam, so make sure for your November exam also you practice such questions. And if you remember the concept, then these questions becomes very easy. Next, Which of the following is an essential requisite of a mortgage by deposit of title deeds? So this question is also from your module E. From the unit 27, where we have studied about the different types of mortgages. We have studied about the simple registered mortgage, a simple registered mortgage, as well as an equitable mortgage or the mortgage by deposit of title deeds. So here you need to answer what is the essential requisite of the equitable mortgage. Both are same. Mortgage by deposit of title deeds is also known as equitable mortgage. So transfer of possession of the property, registration of the mortgage deed, delivery of title documents with intent to create a security, the mortgagee can sell the property without court intervention. So, what is an essential quality? Essential requisite. Basically, what happens in the equitable mortgage, rather than delivering possession of the property, we keep the documents of title, the title deed with our mortgagee, right? In our case, mortgagee is the creditor or the bank, and mortgager is the borrower. Mortgage deed is the contract which is written. Mortgage money will include the principal and interest. These are the basic things. Now, the document of title deeds are submitted to the mortgagee in the towns of Kolkata, Chennai, and Mumbai, or any other town specified by the state government, right? Without delivering possession, we deliver the documents of title to the immovable property, right? So the correct answer will be option C, the delivery of title documents with the intent to create a security. There's no transfer of possession. Registration of the mortgage deed is not required. Why? Because it is deemed to be registered. The mortgagee cannot sell the property without court intervention. So there must be a debt, there must be a deposit of documents. It should be made in one of the notified towns of the state government. The deposit must be made by the mortgager or their agent. The deposit must be made with the intent to create a security. The property can be located anywhere in India. The immovable property can be located in any state, any town. But this mortgage deed will be signed only in the notified towns. Bombay, Kolkata, Chennai, or any other town notified by the central government. All right, so I hope the whole mortgage by deposit of title deeds topic is clear. Try to answer these questions. I'm looking at the comment section. You can answer these questions. If we talk about the simple registered mortgage, what happens there? There also we do not deliver the possession of the mortgage property, but the mortgager binds themselves personally, personally to pay off the debt. And in the event of their failure to pay, the mortgagee will have the right to cause the mortgage property to be sold. All right, so that is a simple registered mortgage. In both of them, there's no transfer of possession. They can sue for personal liability, they can sue for the sale of mortgage property, foreclosure is not allowed, sell the property only with court's permission. They cannot enjoy income out of the mortgage property, and they cannot appoint receiver without the court's permission. These are the characteristics of the simple mortgage and the equitable mortgage. Next, which of the following statements regarding the priority of mortgages are true? Now, when a mortgage is created between the mortgager and the mortgagee, there is a charge, and that charge has to be registered with the ROC, but now we have the SARSAI. SARSAI, which is established under the SARFAESI Act, basically all the charges are registered, modified, satisfied. The register is maintained by SARSAI, right? So what is the priority? Priority of mortgages means when, let's say, there are three banks who have given loan to Mr. A, ABC Bank, XYZ Bank, LMN Bank. And if to all of them the same mortgaged property was kept as security, and Mr. A default on all of these three dues, then when the property is sold, who is going to get the priority? So, a simple mortgage takes precedence over an equitable mortgage in the case of dispute. The first registered mortgage holds priority over a subsequent equitable mortgage. An equitable mortgage created before a registered mortgage will still have a priority. The mortgagee in an equitable mortgage cannot enforce their rights if they lose the possession of the title deeds. So, which of the following statements are true regarding the priority of charges, the priority of mortgages? So, although a simple mortgage is known as registered mortgage, equitable mortgage does not have any rights inferior to the registered mortgage. Why? Because the title deeds are kept and any subsequent mortgage is going to have less priority. So the first statement is incorrect. Okay. Second, the first registered mortgage holds priority over a subsequent equitable mortgage. Same point. Where the equitable mortgage is created, it is going to have priority, right? So the when the mortgager gives the same property in equitable mortgage to one financing institution and in registered mortgage to another one, the priority will be determined on the date of execution. The equitable mortgage will not have any inferior rights. So second statement is also incorrect. Third statement, an equitable mortgage created before the registered mortgage will have priority. Yes. Why? Because once the equitable mortgage is created, the title of deeds have been kept with the mortgagee. Any further mortgage, any further registered mortgage should be declared as inferior. The subsequent financer should have checked whether whether the property is encumbered or not. All right, so this statement is true. Fourth, the mortgagee in the equitable mortgage cannot enforce their rights if they lose the possession. Yes. When the possession of the title deeds is lost, the mortgage is also lost. Right? They should have not parted with the possession of the title deeds. So the correct answer will be C, 3 and 4. The whole explanation is given to you. Now let us take the example of two registered mortgages, two simple mortgages. We are not talking about equitable. So let's say Bank ABC had given a loan to Mr. X in 2015. Bank XYZ also gave a loan to Mr. X in 2020, and both of them they took the same property as mortgage. When Mr. X defaults on both the loans, the priority will be determined not on the date of execution, but first we will check whether the mortgage was registered or not. So if Bank ABC had given the loan in 2015, but they did not get the charge registered with Sarsai, and Bank XYZ got it registered, then the second Bank XYZ will have priority even though it was executed later. So between a charge registered and not registered, the registered one will get priority. Between two registered charges, the first executed one will get the priority, right? So make sure that you understand these things because these questions can be asked in the form of case study or a scenario based question. Okay, next. Which of the following statements about a portfolio manager's role are true? A portfolio manager customizes the investment strategies based on the investor's income, financial goals, and risk appetite. The portfolio manager ensures guaranteed returns on investment without any risk. The portfolio managers only work with stocks and mutual funds, excluding bonds and commodities. Two investors with identical incomes will always require the same portfolio strategy. This is a very simple question. I will give you 10 seconds to answer this. Quickly comment your answers in the comment section. Quickly. Till then, let us discuss the meaning of portfolio management. Portfolio means diversification. If I have accumulated some wealth over the period of time, let's say 50 lakh rupees. Now I want to earn the maximum return on this 50 lakh. Plus, I also want to save for my retirement. I also want to plan my taxes better so that I can claim the best deductions. I have many goals, but I do not have enough knowledge to implement these goals, to decide a strategy that will help me accomplish my goals. So I will approach a portfolio manager, the portfolio manager who is a professional. They will understand my needs, the long term financial objectives, the risk tolerance, and provide a customized solution. They will invest in the various instruments available in the market, in the bonds, in the equity, tax saving instruments, mutual funds, insurance scheme, everything. So they are diversifying my portfolio. First statement is correct. A portfolio manager the customizes a strategy based on the investor's income. Second, the portfolio manager ensures guaranteed returns. No. Even though I will get better returns because the manager has professional knowledge about the market, still any guaranteed returns are not there. So the second statement is incorrect. Then the portfolio managers only work with stocks and mutual fund. No, they work with bonds and commodities as well. They also work with um, fine wines, stamps, old cars, so alternative assets. Third statement is incorrect. Two investors with identical incomes will have the same portfolio. No, right? Different people have different needs according to their goals. The strategy is decided. So the correct answer is A, only one. Only the first statement is correct. All the other statements are incorrect. Next, which of the following assets qualify as long-term capital assets when held for more than 12 months? So we have the capital gains tax that we need to pay on the short-term capital gains and the long-term capital gains. How are we going to decide whether a particular gain is short-term or long-term? It will depend upon the period for which we hold it before selling. So the time period between acquisition and selling will determine the asset classified as long term or short term. So equity shares listed on a recognized stock exchange, units of equity oriented mutual funds, unlisted corporate bonds, zero coupon bonds. Which of the following will be considered as a long term capital asset when held for more than 12 months? 10 seconds. 10 seconds to answer this question quickly. What is capital gains? When I hold some movable or immovable property and I sell it off, there's a difference between the acquisition price and the price that I generate from that sale. That is the capital gain, right? The cost of acquisition and the cost of improvement added to it. So, short term capital gain means property which was held for not more than 24 months, right? That is a short term capital asset. In certain classes, the time period is not 24 months, it is 12 months. Like shares which are listed on a recognized stock exchange, units of equity oriented mutual fund, listed securities like debentures, government securities, units of UTI, zero coupon bonds, the period is considered to be 12 months. So the correct answer is B, 1, 2, and 4. The unlisted corporate bonds are to be held for 24 months, right? The unlisted shares in a company, the period is considered to be 24 months. Other than that, 1, 2, and 4, it is to be held for 12 months and then it will be considered as a long term asset. All right, the explanation, the list of all the assets classified as short term and long term is given here. The correct answer is B. All right, clear everyone? Everyone who's present here, please like the video, share the video with your friends and other aspirants so that they can also join this session and participate. Please participate in the session. Ask me any doubt if you don't understand any point, if you don't understand any concept, we will discuss it. All right, try to participate. Next, branch profitability is determined by factors such as. So, in your module A, there's the topic of branch profitability, right? You need to differentiate between profit and profitability. What are the factors determining branch profitability? The loan recovery efficiency, asset quality and cost of funds, employee training budget, market competition analysis. Let us differentiate between profit and profitability. Profit is an absolute measure. Simply total revenue minus total expenditure, whatever money is left with us, we will say this is the profit that we have earned. Profitability, on the other hand, is a relative measure. It means that now we are comparing the expenses that we have to incur in relation to the returns that we generate. To generate every extra return, how much expense I have to incur. That is profitability. It is a percentage of profit, right? It shows us the efficiency. A company might be generating profits, but the efficiency could be zero or negative. So that is why these two things are different. So the branch profitability is determined by factors such as the loan recovery efficiency, right? The loan recovery efficiency. Asset quality, cost of fund will be profit, employee training funds, market competition analysis. These are less relevant. The most relevant is the loan recovery efficiency. It will tell us how much we are able to generate, how much in comparison to the expenses. All right, the difference and the definition we have already discussed. Next, cost inflation index helps in. Now, cost inflation index again is a topic related to your capital gains calculator. Is it related to the estimation of real estate appreciation, calculating the indexed capital gains, computing the loan interest rate, determining the credit card interest rate? Let us say I had purchased a house in 2023, right? I am holding it for 24 months and deciding to sell it at the end of 2025. Okay, so this is what? This is a long-term capital asset. I'm holding it for more than 24. Earlier, the immovable property was considered to be a long-term asset if held for more than 36 months, but now it is 24, right? Now, during this period of 2 years, some inflation would have occurred, some cost of improvement I had to incur. because of which the value of the property would change. Thus, for the long-term capital gain calculation, we take into account the cost inflation index. Normally, the formula for calculating the short-term capital gain is simply find out the full value of consideration. From it, deduct the expenditure of transfer, cost of acquisition, cost of improvement. But for the long-term capital gain, we'll be deducting the indexed cost of acquisition and the indexed cost of improvement, right? So this indexation is a process by which the cost of acquisition is adjusted against the inflationary rise in the value of the asset, right? Central government notifies the cost inflation index for all the years. Simply for the computation of the index cost, we have to consider the year of acquisition or improvement, the year of transfer, the cost inflation index of the year of acquisition, and the cost inflation index of the year of transfer, right? So how do we calculate? We simply calculate the index cost of, let's say, acquisition. So the cost of acquisition multiplied by the cost inflation index of the year 1 of the year of acquisition, right? Acquisition means, let's just say this is year 2 in which we are transferring the property. So the cost of acquisition multiplied by the cost inflation index of the year 2 in which we transfer the property divided by the cost inflation index of the year of acquisition. So let's say in our example, the property was acquired in 2023. So the CII of 2023 is the denominator. In the numerator, we will have the cost of acquisition multiplied by the CII of 2025. This is how we calculate the index cost of acquisition. For the index cost of improvement, we will say the cost of improvement, the year of improvement, and the year of transfer, right? This index cost applies only in the long term gains and not in the short term gains. So the correct answer is option B. All right, option B. Okay, next. Which of the following statements about the investment banking is true? Investment banks primarily provide advisory services for the mergers and acquisition. Retail banking and investment banking follow the same operational model. Investment bank help raise capital through equity and debt issuance. Investment banks manage liquidity for personal banking customers. So here you need to differentiate between investment management and investment banking. Investment management is for those individuals, the wealthy class that have wealth, they have surplus wealth, and they want to invest it in the various instruments to get the maximum return. Investment banking, on the other hand, is for the people who are in a deficit. They want to raise funds. Let's say a company wants to raise fund to start a new venture. They want to set up a new startup, right? So the investment bank is going to act as an intermediary, connecting the people who need to raise funds and the people who have the surplus fund. Giving you 5 seconds more to answer the question. Try to participate, even if you give the wrong answer, doesn't matter. We have already discussed the difference between investment banking and investment management, right? So the correct answer should be option A, 1 and 3. Investment banks, they provide advisory services, mergers and acquisition, underwriting services, raising capital through selling of stocks or bonds to investors. IPO can be issued by the help of investment bank, right? Yes, the correct answer is A. Absolutely. Great. All right. Next. Which of the following is not a level of Maslow's hierarchy of needs? The Maslow's hierarchy of needs was asked by the institute in the form of case study, right? So the different stages that we have studied in the pyramid that you need to remember. Which of the following is not a level? Physiological needs, security needs, and safety needs, professional achievement needs, or self actualization. So if you remember, there was a pyramid that we had seen in the Maslow's needs in which five stages were there, right? Starting from the basic level needs to the intermediary needs and finally the highest potential, right? So the correct answer is C. Yes, professional achievement needs is not a part of Maslow's hierarchy. We have the physiological needs like food, shelter, warmth, security, and safety needs. We have like housing needs. Then we have the belongingness needs, love and affection. We have the self esteem or self worth needs. And finally, we have the self actualization needs, the highest level need. We apply it to the banking theory as well to understand what are the needs of the customers in the different stages of their life. So, Abraham Maslow, what did they say? They say that people are motivated to achieve these needs throughout their life. First, they need to achieve the basic level, food and water. Then, they need a good place to live. Then, they need family and friends. They want self worth. How will they get self worth? By getting a good job, by getting promotions at their job. If you qualify the JIB exam, your self worth will increase. And finally, the self actualization, which is achieving the highest potential. So, the correct answer is C. Next question. Which of the following is the benefit of the Pradhan Mantri Awas Yojana? Subsidized home loan interest rates, direct cash transfer to the applicants, reduction in the GST rates for property registration, exemption from the property taxes. This question is from your important retail asset product. Under the home loan, the Pradhan Mantri Awas Yojana was introduced. It is a housing loan scheme when in 2015, right? And with the objective of housing for all in the urban areas by the year 2022. This was the aim. So here there are the different categories of beneficiaries. EWS, lower income group, middle income group 1 and middle income group 2. Beneficiary will be a family comprising of the husband, wife, unmarried sons and the unmarried daughters, not owning a pakka house anywhere in India, right? They are going to get houses at subsidized rate. So the subsidized home loan interest rates are offered. Okay? Subsidized home loan means interest subsidy. 6.5% for the EWS and the lower income group, 4% for the middle income group 1 and 4%, 3% for the middle income group 2. Depending upon their income criteria up to 3 lakh, 3 to 6 lakh, 6 to 12 lakh, 12 to 18 lakhs respectively, right? And it is also implemented through the central nodal agencies. HUDCO is there and NHB is there. The National Housing Bank acts as the central nodal agency, right? So this is how the Pradhan Mantri Awas Yojana works. All right. Which of the following statements about the customer relationship management implementation in the retail banking are correct? The business process evaluation is necessary to align CRM with product offerings and customer portfolio management. CRM implementation does not require restructuring of the existing information process. Legacy IT system must be carefully integrated rather than replaced. organizational culture plays an important role. So, although from module C, many questions are not asked, but in this exam cycle, we saw two, three very simple questions from CRM, the customer relationship implementation. Very simple question. So, can you answer this one? Which of the following statements are correct? 1 and 3, 1, 3 and 4, 2 and 4, or all of the above? What is CRM? Basically, having an understanding 360-degree view of the customers, understanding their needs and requirement, then creating products that will satisfy their needs, highest satisfaction possible, prompt service, quick service. We should not missell any product to them. All of these comes under the customer relationship management, right? So statement 1 is correct. Business process evaluation is necessary to align the CRM with the customer portfolio. CRM implementation does require restructuring. Whatever information we have right now, we need to restructure them. No, not D. Second statement is incorrect. Rest all the statements are correct. So the correct answer should be B, 1, 3, and 4. 1, 3, and 4. All right. What is CRM? Basically, the factors that banks have to manage. They have to manage the customers, they have to manage the relationship with their customers by offering the right products, matching the needs of the customers, right? The quality of the service should match the customer's expectation, right? Customer centricity, capturing the customer's profile, designing appropriate product, minimizing the response time, tracking the customer information on a dynamic basis. So we do need to restructure the existing information processes. Now try to answer this one. Which of the following is the primary purpose of CRM in banking? Managing the customer data efficiently, reducing the market competition, standardizing the product offerings across all customers, eliminating the human transactions in banking. What is the primary purpose? Again, a very simple question. Like I said, from the module C, very simple direct questions were asked by the institute. We can expect these scoring questions again. So, as we have already discussed, we are trying to manage the relationship with the customer in the best possible manner. So, yes, the correct answer is A. Managing the customer data efficiently in a dynamic basis, collecting the customer information from the primary sources, secondary sources, internal staff, and so on. Right? So the correct answer will be A. Next, which of the following statements about profit types is true? We have the three levels of profit: gross profit, operating profit, and net profit. You need to identify the correct statement. Gross profit accounts for all the operational expenses and taxes. Operating profit is calculated before interest and taxes are deducted. Net profit is the revenue left after direct cost but before the administrative expenses. The bottom line profitability refers to an organization's cash reserve. Again, a very simple question. If you have thoroughly understood the Unit 4 branch profitability of our Module A, you can easily answer this question. So, the first level of profitability is gross profit. Simply, it means the total sales minus the cost of goods sold, right? The cost of goods sold. This is the gross profit. Then we have the operating profit. From the gross profit, we subtract the operating expenses, which are the selling, general, and administrative costs. That is operating profit. And the net profit is the bottom level profitability after all the expenses, whatever is left with us. So from the operating profit, we subtract the taxes and the interest. Taxes and interest. So this is the bottom level profitability, right? So what should be the correct answer now? I think you can answer it. Try to give me the answer quickly. So the correct answer will be option B. Operating profit is calculated before taxes and interest are deducted. When the taxes and interest will be deducted, it will now become the net profit. All right, so here's how the three levels of profits are calculated. From the revenue, subtract the cost of goods sold, we have the gross profit. From that, subtract the operating expenses, we have the operating profit. From that, subtract the taxes and interest, we have the net profit. I hope you also remember the profit margins, how they are calculated. Profit margins divide, for example, if we want to calculate the gross profit margin, simply divide the gross profit by the sales. So whatever is the gross profit divided by sales. Similarly, operating profit margin is operating profit divided by sales. Net profit margin is net profit divided by sales. We will have a separate session for the numericals where we will practice all of these questions. Everyone who has joined us right now, please like the video, stay till the end. We have just 5, 6 questions more for today's session. Stay till the end. All of these questions are very important and try to participate. All right. Now answer this question. Which of the following statements about the asset reconstruction company issued security receipts are correct? Again, the unit 14 and unit 16 from our module B are extremely important. We have the loan asset classification, the SURFACE Act, the provisioning norms, how the securitization is done, how the security receipts are issued. These topics are extremely important. From these two units, you can expect minimum 10 questions together. All right. So answer this one. ARCs must invest at least 15% in the security receipt issued under each scheme. They are transferable only to other QIBs. ARC must obtain an initial credit rating within 6 months from the date of acquisition. Once issued, the security receipts can be freely traded between retail and institutional investors. So, what happens under the SURFACE Act or securitization? We have the originator, who is the bank, who is the creditor. They will create a pool of asset. Now, this pool of asset can be NPAs or they can also be standard asset separately. Either all NPAs or all standard asset. Together, they cannot mix it. They will transfer this pool of asset to the special purpose vehicle or the ARC. If they are standard asset, then we call it the special purpose vehicle. If they're NPAs, we call it ARC. The ARC repackages them and issues the security receipts, pass-through certificate, collateral debt obligations, whatever. They are issued to the qualified institutional buyers. So this is the whole process. This is the whole process of securitization and reconstruction, right? The SPV will make an immediate payment to the originator. The investors will make the payment to the SPV. SPV will make the payment to the investors from the interest receipt on the underlying asset. All right. What should be the correct answer now? The correct answer will be D, 1, 2, and 3. Option, the statement 4 is incorrect. Why? The security receipts are tradable. They can be traded in the secondary market, but not to the retail investors, only the qualified institutional buyers like banks, insurance companies, pension fund companies, CICs. They are institutional buyers. There's a lot of risk involved in the security receipt that the retail investors do not understand. That is why they're not allowed to participate in this market, right? Other than that, all the statements are correct. Whenever the ARCs issue security receipt, they have to invest at least 15%, tradable only to QIBs, and a credit rating has to be obtained from the CRAs, the credit rating agencies, and it also has to be renewed every year. Okay. Next, which of the following provisions were introduced in the asset securitization regulations? Same topic. From April 1st, 2017, if a bank holds more than 50% of the security receipts backed by its own stressed asset, it must provide a provision against them. From April 1st, 2018, the threshold has been reduced to 10%. Banks can retain the SR beyond the regulatory threshold without provisioning. ARCs must continue to hold 15% under each scheme. So, if you read the statements carefully, you can also use the elimination method. In the elimination method, one statement will be completely different from the other statements. Like here, if you look at the statement 3, banks can retain the SR beyond the regulatory threshold without provisioning. But the statement 1 and 2 says that the provisioning is required 50%, 10%, right? So either these two will be correct or the statement 3 will be correct. So we will eliminate the statement 3 and the correct answer will become 1, 2, and 4. All right, 1, 2, and 4. Next, which of the following factors affect the amount required to be set aside for a sinking fund? Now, the concept of sinking fund and depreciation both were asked in the May exam of 2025. Sinking fund, depreciation, reverse mortgage, that is there from your unit 30, module E. What is sinking fund? Sinking means when it is going down, when over the years of the property, immovable property which is created, it undergoes depreciation due to wear and tear. The profit generation capacity reduces. The property has to be replaced or it has to be rebuilt so that the income may continue for further period. We keep a fund aside, we set this fund for the purpose of recovering the original capital, and that is known as the sinking fund. That is known as the sinking fund. And it depends upon the expected compound interest rate over the structure's life. All right. The amount to be regularly set aside out of the annual income to create the sinking fund depends upon the compound interest that it is supposed to earn over the life of the structure. All right, so the correct answer is D. Next, which of the following statements about the CLSS under the Pradhan Mantri Awas Yojana are true? A beneficiary must not own a pakka house anywhere in India to qualify for CLSS. It is available only for the home loans below rupees 50 lakh. Interest subsidies are granted on home loans for acquisition, new construction, and renovation. The scheme was extended to include the middle income groups. Which statements are correct? So, under the Pradhan Mantri Awas Yojana, where the banks provide the subsidized rate, they also provide the CLSS, the Credit Linked Subsidy Scheme, right? So, in order to expand the formal institutional credit to the housing needs of the urban poor, this scheme is implemented under the Housing for All. through the primary lending institutions, that are the scheduled commercial banks, HFCs, RRBs, SCBs, urban cooperative banks, right? So simply it will be provided on the home loans taken by the eligible urban poor for the acquisition, new construction, addition of room. Earlier there were just two target groups, EWS and LIG. Later on, MIG1, MIG2 were added, right? So these statements are correct, but the threshold of 50 lakh rupees is not there. This threshold is not there. All right, so statement 1, 3, and 4 are correct. 1, 3, and 4. Next question. Which of the following best defines SBU? Again, a very important topic from Module A. In every exam cycle, question from SBU, departmental approach, horizontal, vertical, predominantly vertical, these models are asked. So, which of the following best defines a strategic business unit? A temporary project team within a bank, a centralized department managing the retail banking, a legal entity separate from the bank, a profit center focusing on product offerings and market segments. 10 seconds. You have 10 seconds to answer this question. So, what is SBU? There are two things that the banks or other companies can do. Either they can create separate centers for their different activities. Let's say there's a parent company, they are involved in the manufacturing of cars, also jewelry, also fast moving consumer goods, also any other thing, any consumer goods. All right. So they can say that we are creating separate units for each one of them. They will have their own line of management, command of controls, pricing strategy, products. None of these center is going to interfere with any other center. Or what they can do, they can decide to create departments. The same teams will work for all of the products. There will be the accounting team, the management team, finance team, there will be the advertisement team, right? So, when we are talking about this first approach, where profit centers focusing on product offering and market segment is there, this is known as the SBU. And the second approach, where we keep a unified business, we are not dividing the products, we are not dividing the profit centers, just the departments are different. Then it is known as the departmental approach. All right, so the correct answer is D. Dividing the business on the line of SBUs, that are autonomous divisions, small enough to be flexible, large enough to exercise control. They are profit centers with focused product offering. They can be a business unit of a large corporation or a business in itself. Now, this question you can answer very easily. We have already discussed which of the following statements about the departmental approach are true. The departmental approach organizes banking functions into specialized department like finance and marketing. The public sector banks typically follow the departmental approach instead of SBUs. The departmental approach aligns with the management by objective. Foreign banks rarely adopt the departmental approach. Yes, what should be the correct answer? Now, regarding the departmental approach, quickly answer 10 seconds. So, here the management by objectives criteria or approach is followed in the SBU. They have their objective. This is the goal. This is the pricing. This is the market. They assign it to the different SBUs. But in the department, we are not designing the strategy on business line, rather on the basis of the function that each team or the department performs. right? The accounting department, marketing department, finance department, planning department. And yes, the public sector banks, they follow the departmental approach. SBO approach is mostly adopted by the private sector banks. So the correct answer is 1, 2, and 4. Last question of today. Which of the following mutual fund types is designed to reduce equity investment risk by diversifying across both equity and debt instruments? Debt mutual fund, sectorial fund, ELSS balance. In the debt mutual fund, the what happens in the mutual fund? If let's say I do not have a very large accumulated wealth, right? I can not own any real estate on its own, or I cannot own any asset completely. I do not have that much money. What I will do, I will approach a mutual fund manager. The mutual fund manager creates a pool for many investors. This pool is invested into buying the securities. And I do not own the security, the investor owns the units. According to the units owned, the payment of dividend or interest is done whenever it is declared. All right. So when we are talking about the debt mutual fund, the manager is going to invest in the debt securities. Sectorial mutual fund in the different sectors, like only the shares of the banking company, only the shares of the IT industry, or the shares of hospital industry. ELSS is the equity linked saving scheme for tax saving. But here we are talking about the reducing of equity investment. So, partially into debt and partially into equity. So, it is a balanced mutual fund. The correct answer is D. It will invest money partially into equities and partially into debt, where the investor prefers to minimize the equity investment risk. So they do not want their complete money to be invested only in the equity market because it will be risky. So they want a part in the equity market and the remaining in the debt market. That is all. We have so many more questions to do, so many more topics to cover. So we'll be bringing many sessions on every weekend so that you can attend. For the other papers also, the sessions will be taken. And also, there's an important information for you. The crash course for the JIB November 2025 has started. Here, this is the course for your revision. So all your four papers in English medium will be covered here. You will get mock tests, coverage of the high focus areas, and access to community. I hope you also know about the special features. You can now download and watch the video offline. You also get the memory-based PYPs. You get the short and concise note, module-wise test. But these are the things that you'll get only in the super elite plan. So you can go for the crash course, or simply you can subscribe for the super elite plan and you will get access to all the courses. The foundation, crash course, cracker batches, everything. So join the super elite plan today and attend all the live classes, attend all the sessions, prepare yourself 100% for your JIB exam. Make sure that you subscribe to the YouTube channel because we'll be bringing these important sessions. We'll be discussing all the important MCQs for you on this YouTube channel itself. So like the video, share the video, subscribe to the channel, comment down below if you have any doubts, any queries. You can also download the PDF. The link will be given in the description box. The link will take you to the Oliveboard website. There below the courses, you will have the PDFs option. From there, you can download it. Keep the PDF handy for your revision. Not just the questions, but also the explanation that is provided is important for your revision. So that is all for today. Thank you so much for attending. We will meet in the next session with the further MCQs. Thank you, all the best, and have a great day.